Welcome to Her Money Revolution. I'm your host, Angela Brooks, your guide on this journey to becoming a wealthy woman. As a certified financial planner, owner, and advisor at Family Capital Management, I'm on a mission to simplify the conversation around investing and to help women generate more wealth by making their money work for them. Join me as we navigate powerful financial planning strategies to help you achieve your personal and professional goals. This podcast is your go-to destination for no fluff, easy to implement financial and investing advice. If you are ready to achieve audacious financial goals, dream beyond boundaries, and generate massive wealth for you and your family, this podcast is for you. Grab a notebook, let's get started. Hello and welcome to Her Money Revolution, the podcast where we empower women to grow their wealth by making their money work for them. I'm your host, Angela Brooks, and today we are diving into a topic that's not just about saving money. It's about maximizing your wealth. It's about tax planning strategies. Now, before your eyes glaze over, before you change the channel, hear me out. Listen, tax planning isn't just for the super rich or the ultra savvy. It's for you. It's for me. It's for everyone who wants to keep more of what they earn. I don't like paying taxes just as much as everybody else. Every year, I literally sit down and look at how much we're paying in my business and in my personal tax, and I cringe. Oh my goodness. It's the moment where I think there must be a way to pay less. I don't want to pay so much in taxes every year. My business partner always laughs at me, and he's like, oh no, here she goes again, trying to outsmart the IRS. And we laugh about it. But truly, I'm telling you, it's not about outsmarting, it's about strategizing, right? So honestly, who doesn't want to keep more of what they earn? I know that I do. So today, I'll share actionable tips and strategies that you can use to lower your tax burden and grow your wealth. I know we've got our tax deadline coming up in just a few weeks, actually April 15. So if you haven't already filed your taxes, be sure to turn it up and take some of these strategies in place. And if you already have, it's okay. For 2025, actually, a lot of these strategies that I'm going to cover, if you haven't done them already, it's probably a little bit too late. So just focus on 2025 and implementing some of these strategies. I also do have to start with a disclaimer, okay? So this information shared in this episode is for educational and informational purposes only. I am not a certified public accountant. I'm not a CPA. I'm not a tax professional. And this content should not be considered specific tax advice. I don't want to get in trouble by telling you to do something and it's not accurate for your situation because everyone's financial situation is unique. So I strongly encourage you to consult with a qualified tax professional or a CPA for your personalized advice that's going to be tailored to your specific situation and for your circumstances. But with that in mind, let's dive in. Tax planning is one of the most overlooked areas of wealth building. Oftentimes I meet with clients and they're all about growing their investments and getting the best return that they can, but we don't pay attention as much to tax planning. I do in my business, but many people do not. It's one of the most impactful planning techniques that you can implement for your financial future. Think of it this way. Every dollar that you save on taxes is a dollar that you can invest. $1 that you can save or $1 that you can spend on a dream vacation or something to achieve your wildest dreams and goals, right? It's not about tax evasion. Trust me, I don't want to lose my license. I'm not trying to do anything illegal or encourage you to do anything that's not legal. It's about using those legal strategies, understanding the tax law and what things that you can do to reduce your tax liability. So whether you're an employee or you're a business owner or someone planning for retirement, proactive tax planning will make a huge difference. So I'm not going to get into specifics about business owner, if you're a business owner, because there's a lot that you can do. Maybe that will be another episode in the future, but this is more of a generic tax planning tips for everybody. If you're an employee, if you're a business owner. So I'm going to go through 9 tax planning tips. Number 1, it starts with understanding your tax bracket. right? So if you're paying your taxes, you want to understand your tax bracket. You can't really plan for the future if you don't know where you are today. So the first tax planning tip is to figure out what federal tax bracket you're in. In the United States, we have a progressive tax system. So that means that people with a higher taxable income are subject to higher tax rate, right? While people with a lower taxable income are subject to lower tax rate. So understanding where you fall in your federal tax bracket is essential to having proper tax planning. There's 7 different federal income tax brackets for 2025, 10%, 12, 22, 24, 32, 35, and 37%. So no matter which bracket you're in, you probably won't pay that full rate on the entire amount, right? So like if you're in the 35% bracket, not all of your income is being taxed at 35%. So you get to subtract tax deductions to determine your taxable income. That's why your taxable income usually isn't the same as your salary or your total income. Another thing to keep in mind is that you don't just multiply your tax bracket, that 35%, by your taxable income, right? Instead, the government divides your taxable income into chunks and then taxes each chunk in that corresponding rate. So the first, I don't have the numbers off the top of my head, but 100,000 is taxed at 10%. Next, 100,000 is 12%, for an example. Okay, number 2, the difference between tax deductions and tax credits. We need to understand that. So tax deduction and tax credits may be the best part of preparing your tax return. Both of them reduce your tax bill, but in very, very different ways, okay? So knowing the difference will create some very efficient tax strategies that can reduce your overall tax bill. So let me explain a tax deduction. They are specific expenses that you've incurred that you can subtract from your total taxable income. They reduce how much your income is subject to taxes, okay? And so then there's tax credits, and these are even better. So we really want to be mindful of the tax credits because they give you a dollar for dollar reduction in your tax bill. So for instance, a tax credit valued at $1,000 lowers your tax bill by $1,000, right? So I know I'm going to get into a little bit of some numbers here, but if you just can stay with me. So if you have, let's say you have a $10,000 tax deduction and a $10,000 tax credit. Okay, so your AIG is $100,000. When you have that $10,000 deduction, you take $100,000 minus $10,000, which gives you a taxable income of $90,000. So then your tax rate roughly is 25%. So to calculate your tax, take 90 times 25% for easy conversation. Your calculated tax is going to be $22,500. Okay. So again, it's a progressive tax system, so it's not exactly 25%, but I want to give you this example. So $22,500. Now, if we do the same situation, but you have a $10,000 tax credit, so your AIG is $100,000, your taxable income then is $100,000. So then your tax rate is 25%. Calculate your total tax, right? 25% of 100 grand is $25,000. But listen, that's not your tax bill because then you have your tax credit. So you take $10,000 away from that $25,000 calculated tax to get a total tax bill of $15,000. So that's a big difference, right? 22.5 versus 15. So understanding the differences between, maximizing your tax deductions and then taking advantage of all of the tax credits that apply to your situation. Number 3 is taking the standard deduction versus itemizing. So deciding whether you want to itemize or take the standard deduction is a big part of tax planning. It's the choice that can make a huge difference in your tax bill. So the standard deduction, basically, it's a flat dollar, right? So no questions asked, tax deduction. So taking the standard deduction makes tax prep a lot easier. So if you do your own taxes, you're like, fine, I don't want to go through and try to find all of my charitable contribution receipts. I don't want to have to go through all of the different itemization. that I have. So I'm just going to go ahead and take that standard deduction. So your tax prep goes a lot faster, which is probably a big reason why many tax players do this instead, instead of itemizing. But also Congress sets the amount of the standard deduction, and it's typically adjusted every year for inflation. The standard deduction that you qualify for depends on your filing status, right? So are you married filing jointly, married filing separately? Are you a single taxpayer? But for 2025, the tax year, your standard deduction for married couples filing jointly is $30,000. And the standard deduction if you're single in 2025 is $15,000. So let's talk about then when you would want to itemize. So what does that even mean? Well, instead of taking the standard deduction, you itemize your tax return, which means taking all of your individual tax deductions that you qualify for one by one. Generally, people would itemize deductions add up to more than the standard deduction. That's when they would want to itemize, right? So a key part of their tax planning is to track all of these deductions throughout the year. Now, listen, we're early in the year. It's March. So you still have time. Don't wait till November or December, or even worse, January, February of the next year to start tracking those deductions. Set up an Excel spreadsheet. And if you have receipts, take a picture of them, get a folder, and track them throughout the year. Because that's the drawback, right, to itemizing is that it takes a lot longer to do your taxes and that you have to be able to provide or prove the qualified expenses and itemization for all of the deductions that you have. So you want to keep that proof all throughout the year. You use the IRS Schedule A to claim your itemized deductions. And then some tax strategies may make itemizing especially attractive. For example, like if you own a home, your itemized deductions for mortgage interest and property tax may easily add up to way more than the standard deduction. And that could really save you a lot of money. And we don't know what's going to happen yet, but at the end of 2025, if the current tax code sunsets, this could really be a great advantage of you, if you have a big mortgage interest or property tax bill every year. Another thought too on that is that you might be able to itemize your state tax return, even if you take the standard deduction on your federal return. So pay attention to your state laws if you're able to do that. And then the good news, if you do your own taxes, there's tax software or a good tax preparer can help you figure out which deduction you're eligible for and whether they should add up to more than the standard deduction. So if this feels like way more than you can understand, talk to the tax preparer, look at this tax software and see, what items you could deduct versus if you should just take the standard deduction. All right, number 4 tax planning strategy, deduct what you're entitled to. Many people, even people that have wealth advisors like myself, I see it all the time, leave money on the table by not taking full advantage of the deductions or the credits that they're eligible for. So be mindful. There's a list. There's a ton of them. But let me just give you just a few here. Obviously, charitable contributions, right? So cash donations, goods, even mileage for volunteering work can be deducted. That's one that's missed a lot. If you go volunteer, track your mileage. That can be deducted. Charitable giving should always be part of tax planning strategies, especially for high net worth individuals. It's necessary. I don't want to say necessary because if you don't have a charitable mindset, then it's not. But if you are a high net worth individual or a couple, it's an amazing strategy to help avoid taxes. Not only that, you're giving back to your local community or whatever nonprofits that you're passionate about. Additionally, this approach not only provides tax benefits, but also aligns, with your values and your social responsibilities. So I would really encourage you that if you're a high net worth individual and you're not donating or you're not charitably planning, to call me or to work with someone that can help you, because it is really impactful for your taxes and for, I think your social responsibilities. You can certainly reduce your taxable income by deducting cash donations, obviously. By donating assets like appreciated securities, you'll bypass capital gains tax while claiming a tax deduction for the value of that security donated. So this is a strategy that I use often. I have clients, we open up a donor advised fund. If they have a big year, maybe they sell a business or they've got a big taxable event, then you can take appreciated assets. So let's say you have, SPY and it grew 82% and you've got a huge tax if you sell that position, then you're going to have a huge capital gains tax. Well, rather than selling it, you would transfer that security, that appreciated security, as long as it's long-term, so it's a year and a day, you transfer that security over to your donor advised fund, you bypass all of that capital gains tax. So then it sits in your donor advised fund. Then there you can sell it, or you can keep it invested and have it growing. But then if you sell it, then you're able to have that cash tax free as long as you then donate it to a nonprofit, which is, that year that you transfer it over into the donor advised fund, that's the year that you get that tax advantage because that's the transfer. You could let it sit there for multiple years, but when you take it out of the donor advised fund and then gift to a nonprofit, you don't get to double deduct, right? So you don't get another charitable deduction on your taxes when you gift it from the DAF. So anyway, charitable contributions is a great strategy to consider. Another credit, education credits. There's lifetime learning credit or the American Opportunity Tax Credit. They can really offset any educational costs that you may have. My husband and I take advantage of these. A child and dependent care credit. If you pay for childcare, you know how crazy expensive it is. This credit can reduce your taxes by $5,000. So that's a great credit to be mindful of. There's adoption credit, medical expenses, can't even list them all. There's so many more. If you're a business owner or you have a side hustle, your deductions expand even further than all of these, right? So things like your home office expenses, your travel expenses, your equipment, marketing costs or all of the office supplies, all of these are deductible if properly documented. Again, that's something that I want you to be really, really mindful of, is to document all of these expenses, right? Equipment you can depreciate over years. Again, work with a CPA if you have questions on that. And then also, I'll share a link in the show notes that will give you a list of all the different deductions and credits that you can take. So be sure to look at those notes. Okay, how are we doing? Are you sticking with me? Hopefully. I know sometimes this gets a little bit like, but keep listening, okay? So number 5, maximize tax-advantaged accounts. This is where bread and butter for me, right? So deductions and credits obviously are a great way to cut your tax bill, but there are other tax planning strategies that can help shelter income and cut your tax bill by quite a bit, okay? And it's easy. So this is one of the easiest ways to reduce your taxable income is by contributing to tax-advantaged accounts. For example, traditional 401k or a 403b. So contributions to these employer-sponsored plans are made pre-tax, which then lowers your taxable income now, and it grows your money tax deferred. So I've talked through this in different podcasts or different episodes, but be mindful of that. It's a traditional 401k that is pre-taxed. If you have a Roth 401k, that's post-tax. So that doesn't help cut your tax bill in this year that you make contributions. But similar to the traditional IRA, right? So like a 401k, contributions may be tax deductible depending on your income level. If you make too much, you cannot make deductible contributions to a traditional IRA. Now, listen, if you make too much and you can't make contributions, you can always make contributions. Whether they're deductible or not depends on your income level. So if your income level doesn't allow you to make deductible contributions, don't contribute to an IRA. There's other strategies out there. You could do a backdoor Roth or even just a taxable account, but I don't love, and this might be, other advisors may tell you differently, but the advantage of having a traditional IRA is having that tax deduction, when you make those contributions. So be mindful of your income level. Another strategy is a health savings account. So HSAs are triple tax advantaged, right? So your contributions are pre-tax, the growth is tax-free, and the withdrawals, as long as they're for qualified medical expenses, are also tax-free. So, however, if you have an HSA and you use it for something that's not a medical expense, you do have actually a penalty and then you pay taxes. So this health savings account is specifically for medical expenses, but when used for medical expenses, you get triple tax advantage. So that's awesome. That 2025 limits that I have on my resource page at hermoneyrevolution.com tells you how much you can contribute to an HSA and some other disclaimers around that. So be sure to download that if you don't know what you can do there. Don't forget catch-up contributions. So if you're listening and you're over 50, you are allowed to contribute an extra amount into your retirement accounts. That gives you added tax break, right? While boosting your savings for retirement. So look up those catch-up contributions for each of the different, like a traditional IRA or a 401k, HSA. There's multiple different ones. So download that resource that I have available. Another great way to minimize your tax bill is to open up a 529 account if you have children or grandchildren. This is a savings account that's operated by most states, right? Some educational institutions, I think, have them as well, but they help people save for college. So you can't deduct the contributions on your federal income taxes, but in Michigan, you're able to deduct on your tax return as long as you're putting money into a Michigan 529 plan. Okay, other states work the same way. There's different rules and requirements for each state. If you live in Michigan, you can make contributions to a Michigan plan and take state deduction. Now, listen, if you live in Michigan and you have a Ohio 529 plan, that doesn't do you any good. I mean, you're still putting money aside and investing, so that's great, but get a Michigan plan. Another strategy is to use dependent care flexible spending accounts. So what is that? Dependent care flexible spending accounts. Okay, so this is another really handy way to reduce your tax bill if your employer offers it. So ask your employer first if they do. Some don't, but the IRS will exclude up to $5,000 of your pay that you have your employer divert into a dependent care FSA, flexible spending account, okay? Which means that you're going to avoid paying taxes on all of that money. So that can be, like for me and my husband, it's pretty great, right? It's huge for parents that have kids because before, or that we're paying before and after care school or daycare, preschool, day camps. All of these things are usually allowed to be able to use that $5,000. So what's covered, though, can vary among different employers in different states. So double check with them and see what your plan documents say. But if you have kids, look into it for sure. Another strategy that I've already mentioned, but start a donor advised fund. I frequently suggest a donor advised fund when helping with tax planning for my high or ultra high net worth individuals who want to donate to charities, right? It's a really great strategy. So with a donor advised fund, like I said earlier, but you can contribute a substantial lump sum donation, which is fully deductible in that same year, in the same fiscal year. Okay. So when you couple this with capital gain or a similar size during the same taxable year, the donor advised fund really helps save you a lot of tax money. Also, as a bonus, you control the fund, right? So although you're donating it and it's not part of your net worth anymore, you can still manage how it's being invested or have an advisor that's managing how those funds are being invested. So it really allows you or your heirs to determine when and where you want donations to go and how you want to have them invested. Number 6 is to leverage Roth accounts. All right. So while, like I said earlier, the traditional accounts, they provide immediate tax savings. They're super great. But if you're past that income limit, you're not able to make deductible contributions, Roth accounts offer tax-free growth and withdrawals in retirement. So you may not have that advantage today and this year, but you want to think about your future self, and your future self will thank you, right? So if you're expected to be in a higher tax bracket later, maybe you're young and you have low income right now, but by the time I'm 40, I better be making double what I'm making. If that's you, you want to contribute to a Roth IRA or a Roth 401k if your employer offers that. So if you do that now, you can save significantly more money in the long run because this Roth IRA grows tax-free, right? So if you are in a low income bracket, you expect to be in a higher one later, contribute to a Roth IRA. That would be my boilerplate recommendation, because later when you're in a higher tax bracket, then you can start building up portfolio, a traditional IRA, for example. And then later in life, you're more diversified where your assets are held. So if you ever need money, which I work with this all the time, I have clients that are 65 and they're like, hey, I need 10 grand. And it's like all traditional IRA funds because all they did was a traditional 401k. And it's like, well, everything's taxable. So you lose control. So you lose the power to say, where can I want to avoid paying taxes, but I can't because everything's going to be taxable. So if you start to diversify your asset type, have some in Roth, then when you're looking for 10 grand, you're like, okay, well, I can take some from my Roth tax-free and then a little bit from my traditional and pay a little bit of taxes. But it gives you the advantage to be able to take money from the most tax favorable bucket. And I said this earlier as well, but again, if your income exceeds the Roth IRA contribution limits, because there's that as well, look into the backdoor Roth strategy. I love this. It's a really great strategy to get money into a Roth IRA. It's legal. It says backdoor. It feels a little like sketchy, but it is a legal way to convert traditional IRA non-deductible contributions into a Roth IRA. You have to have a zero balance traditional IRA though. Okay. So you can't have an IRA. It's got 50 grand in it and then convert a little bit to a Roth and have that be that backdoor Roth. You can't do that. You have to have a zero balance traditional IRA, make non-deductible contributions to that zero balance traditional IRA, and then in the same year, convert that over to a Roth IRA. All right. Number 7, understand tax loss harvesting. This is a big part of my job as a wealth advisor. If you're working with one, ask them what their strategy is for tax loss harvesting. If you have taxable investment accounts, right? So like a joint account or a trust or an individual brokerage account, tax loss harvesting is a great strategy to offset any kind of capital gains. So this is how it works. Let me see if I can explain this to make sense for you. So when you sell an investment at a loss, you can use that loss to offset gains from other investments. Okay. Yeah. So I won't go further than that, but it's a really great strategy to be mindful of all throughout the year, right? So if your losses though exceed your gains, you can deduct up to $3,000 from your ordinary income each year. So that's another really great tax strategy. And then any kind of losses that you have that you can't offset, you carry them forward, okay, indefinitely. So for other years. So I have clients that have, 60 grand of carry forward losses that we can take advantage of in years ahead when they need income. And like today, the market's doing great. Everything's up. If you need cash, okay, great. We can go ahead and place a trade, add a gain, and use our carry forward loss. So anyway, it reduces your tax liability and then lets you reinvest in new opportunities as well, right? That's like when we do a rebalancing. All right, number 8, plan for retirement distributions. So if you're nearing retirement, how and when you withdraw from your accounts will significantly impact your taxes. Okay? They just do. So here are a few tips to help plan for those distributions. So, and again, this isn't specific, so this is like kind of high level, but start Roth IRA conversions early. There's a sweet spot, I like to say, between, when you retire, when you have no more earned income, and before you start taking Social Security, or before you're required to take required minimum distributions. There's a little sweet spot where it makes sense to say, hey, my income is really low. This is a low income bracket. And you convert a portion of your traditional IRA or your traditional 401k to a Roth IRA before you're required to take that RMD. It spreads out your tax liability over time, right? So when you're in a lower income tax bracket, converting that Roth IRA, you pay minimum in taxes because you don't have other income coming in. And then that all grows tax-free. So I love doing Roth conversions. Again, there's a sweet spot. Be mindful of that. I had a friend, actually, she's my age, and she converted her entire traditional 401k, like in the prime of her earning years, and ended up paying a lot more in taxes. She wasn't aware of that. But anyway, it's all in Roth now, so it's growing tax-free, but it was not a pleasant surprise for her. Another retirement distribution strategy is that you want to be strategic around your required minimum distributions, right? So the age at which the account owner must begin taking RMDs is 73. That keeps changing. It was introduced by Secure Act 2.0 in 2023, if I remember correctly. So you apply to the traditional retirement accounts, right? So traditional IRA, traditional 401k. And so working with a financial advisor can help you avoid any kind of penalties that you would incur if you don't take out your RMDs. So this is a big project at my company that we make sure anyone that is an RMD age is scheduled to take out whatever that dollar amount is by year end. You don't have to wait. You can start taking it out January 1st, but it has to be fully taken by December 31st, by year end. I'd encourage you to do it earlier in the year, or at least by, November. Don't wait till year end and try to figure that out. Oftentimes, a lot of the custodians are doing a lot of those last minute donations and RMDs, and sometimes it just gets missed. Or if you are donating, you can take your right from your IRA. It's called a QCD, qualified charitable donation. You can gift it right to a nonprofit. And if you're sending them a check, sometimes those checks don't get at year end. Sometimes those checks don't get cashed until January or February, and it just messes up your taxes. So it's messy. So if you're going to do that strategy, try to do it like July. It's easy. It makes my job easier as well, to make sure that everything is like tracked and the 1099s are correct and all of that stuff. So the RMD age, again, I said that changed. So if you were born before 1949, you're already taking RMD. Your age was 70 and a half. So that changed, though, if you were born, let me see, was it 1951? I think, I had the, so if you're born after 1951, your RMD age is 73. If you're unsure, ask your advisor or look it up. But your RMD age after 1951 is age 73. So you want to plan ahead. You want to work with a professional guidance. If you don't understand all of this, it makes a big difference, right? Last but not least, number 9. I feel like I've said this 100 times already. Work with a professional. I'm not saying that you can't do it on your own. You might. If you're enjoying this episode and all the jargon, you might love doing it on your own. But tax planning is complex, right? Especially when you're juggling multiple goals or multiple income streams. And when you work with a tax professional and a financial advisor, it helps to optimize every opportunity while staying within the law, obviously. So, and if you work with a financial advisor and they're not asking to talk to your CPA, that's a red flag, okay? That's a problem. I talk to my client's CPA like all the time, right? I want to make sure the advice that I'm giving is actually implemented in real life on their taxes and on their returns, and that we're all on the same page. So be mindful of that as well. If your wealth advisor doesn't have a relationship or have correspondence with your tax professional, I don't want to say find a new advisor, but maybe it is time to look for another advisor that's going to really quarterback a lot of your professionals in your life, especially if you're a business owner. Anyway, I'll digress there, but think that through a little bit if that's your situation. So my main goal here with this episode is that we are mindful and that we are being proactive in our tax planning. Okay. It isn't just about saving money and putting money into retirement accounts, right? It's about creating more opportunities, understanding your tax situation, how you can save more money that you earn, and understanding how that impacts you today and in your future, right? Every dollar saved on taxes can be reinvested. Again, it can be saved, or you can use it for, maybe you want to start a small business, right? Maybe you want to do something like wow and crazy, buy a boat, or just save it so you can support the life that you want to live in retirement. So the bottom line, tax planning is one of the smartest ways to maximize your wealth. When you look at how much you pay in taxes, and listen, when you file your taxes and maybe you owe $500, that's not all you pay in your taxes. Make sure you're really mindful of how much comes out of your paycheck every or biweekly or whatever your pay structure is. You pay a lot in taxes. It's not just what you pay when you file your taxes, okay? You want to understand these 9 tips. It will help you reduce your tax burden. It's going to keep more of what you earn in your wallet or in your investment accounts for your enjoyment today or later in life and retirement. I hope that today was helpful. Maybe you took some notes. If you have questions, send me a DM. I get a handful of them. I love them. Thank you. Keep asking me some questions. I try to get back within just a couple days, but if you don't hear from me, maybe just ping me again. But I really value you. I really love that you guys are listening. This podcast is growing and I'm so excited. So hopefully that we can keep growing together. If today's episode has you rethinking your approach on taxes, take action, okay? Do something different about it. Review your current situation. Talk to a professional or a CPA. Start making those money moves that will benefit you today and in your future. Your future self will love you. I promise. Thank you for tuning in to Her Money Revolution. If you found this episode helpful, please share it with a friend who could use some tax tips. And don't forget to subscribe, leave me a review, connect with me on social media. Keep sending me those DMs. I absolutely love it. Until next time, remember, financial empowerment starts with you. Thank you for joining me today, and I hope you are feeling more empowered in your financial journey. Remember, follow and subscribe to Her Money Revolution on your favorite podcast platform, and share your feedback by leaving a review. I'd love to hear your biggest takeaway from today's episode. Until next time, stay inspired.